Let's talk money.
Hello and welcome. You're with us on Let's Talk Money. I'm your host, Surabhi Upadhyay. This is an important episode because it deals with regulation. Market regulator SEBI has come out with a draft proposal that seeks to alter the rules that govern mutual funds. Now, this is a proposal which includes changes in regulations for thematic funds, sectoral funds, value, as well as contra funds, just to name a few. SEBI is also considering allowing asset management companies to launch a second scheme in the same fund category if the first fund or the first scheme has become too big to manage. So we'll talk about all of this and what these changes could mean for us investors with Feroze Aziz of Anand Rathi Private Wealth. And since Feroze is here with us, we can't let him go without making him give us some fund ideas. So today, Feroze on the show is going to talk about some underperforming funds which could be turning the corner very, very soon. So stay tuned for that. Feroze, great to have you back in the studios. Thank you so much for joining in.
Likewise, Surabhi, it's always a pleasure to be with you.
So I know the hotter topic is these funds which are underperforming and which ones could start turning around. But before we talk about that, the whole cyclical nature of mutual fund performance, let's spend a couple of minutes because we really want to understand this new SEBI circular. I read through it, fairly exhaustive. It's talking about a lot of changes, categories, what can the portfolio hold, not hold. What are your first thoughts?
My first thoughts are that SEBI has started going deeper and deeper and logically, more and more logical with its decision making. So that's the first thing if I look at a circular 5 years back to today, the circulars, or at least proposed circulars or proposed draft circulars are so married to the ground reality and the client's centricity has, if I have to rate this on the client centricity scale, I would say it's 9 on 10. If the 5 year back circular I would have read, there were some collateral damages to a client, but this is a beautiful circular.
Okay.
But there are three broad headlines on which the circular is operating. One is to say what additional leeway can be given to the fund manager to deploy his underutilized cash when equity markets are overheated. That's one.
Yeah.
Second, intersection between schemes create bubbles in stocks. And they smudge the line for a client to decide which one to buy. That's the second area.
Yeah.
The third is bigger schemes.
Yeah.
Again, when there is difficulty to manage, what can a fund manager do? So it solves fund manager problems, market valuation problems, and clients' return being enhanced. If a fund manager is not believing in equity today, and if he has 10% cash, what are his other alternatives other than leaving it in GSEC and at 5-6% is what it addresses. So all three stakeholders, important ones, have been covered.
Absolutely. And you've distilled it down so very nicely for us. I think over 20-page long circular. And those are the three broad pillars that we as investors need to be aware of. So let's take up the first one, where the circular is now willing to offer. By the way, these are not final rules as yet. It's still, I think, a draft proposal. But SEBI is now proposing that, let's say, if you have a large cap fund or if you have a mid cap fund, and there are certain set limits that for a large cap fund, at least 80% must be in large cap stocks. What SEBI is saying that whatever is the residual portion, so in this category, the residual is 20%, say, that, Feroze, that can now be invested in equities, in gold, silver, and I think even REITs, right?
Correct. Yes. So can a fund manager be given a larger canvas? The answer is yes. Will people utilize their full limits? The answer is no. But if we trust the fund manager and his judgment and the asset management company's research, should he be limited to not having gold in the portfolio momentarily? The answer is, I would say that give them the freedom. If you trust them, trust them all the way, not just with equity, because they're not individual. See, asset management companies in India are about 40, 45, right?
Yeah.
It is not like a PMS where there are 500 licenses given. So it's more institutional. Mutual funds are more institutional driven. So it's not just one person driven. Like PMSs could be one person driven. So when there is an institution, there would be somebody running a gold fund, gold ETF. So you can borrow, as a large cap fund manager, I would love to borrow my neighbor's fund manager's skill to see whether can I park money in debt at 6% or I think parking that money in gold for a year, the additional 20% will make more sense. So I think I would say this is one step better than giving them a larger canvas to borrow institutional capability.
But they will have to, I'm not sure if it specifies that the fund manager will then have to park the residual portion in the scheme of their own AMC. Is that how it's going to be? Or can the fund manager actually buy gold or debt market securities and then add on in the fund.
No, it will not be a fund of funds.
It can't be a fund of funds, yeah.
But just that if you have research on REITs, for
Yeah.
example, REITs have finished 6-7 years in India. The first one was Embassy REIT.
Yeah.
If there is being research being done for another fund, you can borrow that research and then act on it or not act on it directly. You're absolutely right. It will not be a fund of fund. But I will have research on the same floor.
So you can add that to the portfolio if you feel that that particular main asset class doesn't it's not necessarily giving the best returns in that period or that point in time. Let's talk about the second aspect, and Feroz, this is a really important one, right? This stems from the flurry of NFOs that we had. Sectoral funds, thematic funds, defense funds, whatever is in flavor, you'll see NFOs coming out on it. So now SEBI is saying that portfolios should not be overlapping each other. Explain to us what is being implied and why it's important.
Surabhi, sector and thematic funds can be any number. See, large cap fund was curtailed, mid cap fund one. All the categories had one. There was one which is sectorial and thematic. There is no limit on the number of themes you can have, right? You can create any theme for that matter. But if you are creating themes just to have NFOs, not all AMCs do that, but you are sometimes tempted from a marketing and a sales standpoint to create capital market theme and then financial infrastructure.
Financials.
If you say financial infrastructure, then you have all these scams and the Karvis and whichever are the listed, KFINs, NSDL, CDSL. These are all finance infrastructure. That's a theme. Capital market is a theme. Now there's an intersection. So if you are going to confuse the client, at least make sure that there is lesser intersection. So because then everything which SEBI did in 2018 to regularize and reduce confusion, for which we have all seen the benefit, how the industry grew when you don't confuse a person. Like there's a study which says in a store, somebody was selling shoes, right? His art was, he says he sold, when he left two pairs, before he brought the third, people would buy nothing. He would always take back one pair to bring the third one back. So he, at any point in time, a customer was never given more than two choices. The sale doubled. So that's what SEBI did to the mutual fund industry, and we don't thank SEBI enough. That's what it did in 2018. If I had 5 large cap funds, I'm selling less. If there's one SBI has one large cap fund, his sale went up. Because there's lesser confusion. Lesser confusion means more action.
Absolutely, absolutely. So that is one thing that overlaps between these portfolios, whether it's a sectoral funds, thematic funds, or even value funds and contra funds. They should not have more than 50% overlap. That's what SEBI is proposing. The third important proposal that's come forth is allowing big funds to shut down and open up a secondary scheme. And I think this, for large AMCs and their flagship funds, this could go a long way, right? Because they've been complaining that the total AUM is so large that it's not easy, it's not agile anymore to manage the fund.
Absolutely. See, if you just visualize a fund manager, he's already getting a lot of money. He's not able to find so many ideas where he can deploy the existing cash. Now he has, let's assume, 47 stocks. I was speaking to somebody, some CIO. He's personally managing that. He's got 47 stocks. He knows that he wants to get rid of these 5 stocks. Now there is a lack of 5 new ideas which he has to bring in. He has to also see unko SIP 400 crore ki aa rahi hai mahine ki. Where does he put this 400 crores itself is a big problem to solve. And then he has these 5 to exit, and then he has to find credible, better solution than an exit. So it becomes very difficult. So its fund managers' lives have become very difficult to deliver performance. And the sales team of the asset management company is asking performance.
Of course.
And this is why it's a fund manager's biggest nightmare to manage a large fund with influx.
More money
so much money coming on a recurring basis. So I think that's the beauty, that you can launch a new fund. And my biggest fear of launching a new fund was then again people launch new funds and again it will become cluttered. But what SEBI has done very, very sharply is saying that it will borrow the same expense ratio from the first fund. If you're launching a second fund, you have to close the first fund, right? And the fund manager should be different.
Okay.
So all these protect any clutter and confusion which will build up if SEBI wouldn't have done this, or in the consultation paper, 10 years later again we would be solving what we solved in 2017-18.
Which is confusion, clutter, too many overlapping kind of funds. So it seems that all the proposals are getting at least Feroz's thumbs up, and it seems the MF industry perhaps will see it as a positive as well. Final point on this SEBI consultation paper, and what caught my eye, Feroz, was that they are talking about innovation in certain product categories. So mutual funds have these solution-oriented schemes, right? A retirement fund, children's fund. Now this paper is saying that within these categories, you can have 3 different types of funds. So for retirement, someone who has more risk-taking ability can go for an equity-oriented retirement fund. Someone who has a more conservative bent of mind, they can go for a debt-oriented retirement fund. And someone who's in between can go for a hybrid option. What did you make of this? And also give us an overview. I mean, how has the MF industry done when it comes to these retirement solutions? Do they really do the job?
In the current format, no.
Okay.
That's the good part of the change proposed. I'm sure this must be instigated by AMFI because that's, now if you look at SBI, SBI's retirement scheme has 2 options. One is the hybrid option with 38% equity and the conservative option with 19% equity. Now, in the wildest of my dreams, I would not plan my retirement using 38% as my maximum equity allocation.
Yeah.
Right? And even if I'm going to retire after 4 years, I will have more than 38%.
You want more equity, yes.
More equity,
Yeah,
right?
yeah.
In a high inflationary economy, your retirement plans, already we have numerous retirement plans running for 3-4 decades by government. All of them are debt.
Correct.
EPF is
Yeah,
debt,
yeah.
PPF is debt,
Yeah.
small savings is debt, everything is debt, and only mutual fund platform where retirement as a concept is being sold in a solution format has 38% equity in the largest asset management company. Does it require addressing? It requires addressing. SEBI is taking up that. I'm very happy because what Nirmala ma'am, Sitaraman ma'am has done is said that it has given the message saying that मैं आपके पैसे आपको decide करने दूंगी. I will not force retirement solutions on you
Yeah.
by changing the new direct tax regime.
Correct.
Right? And she's been motivating them from 2021.
Yeah.
If you're doing that and if you're going to take decisions and if you're not going to change your asset allocation, then you might as well have delegated to Nirmala ma'am.
But that is really saying something that till now, the maximum equity allocation in a retirement fund in India, managed by mutual funds, was just 38%. And which AMC was this, Feroz?
See, I'll tell you, the equity, I know of the SBI's,
Okay.
maximum is 38.
38.
Now, if you look at UTI retirement fund, which is the oldest retirement fund with 31 years, that also has 38 incidentally. Axis retirement fund has 38. All of them are below 40, but there could be some. There could be more equity, but I'm just looking at the top asset management company, SBI, and they're 38.
And so therefore, the average return over, I mean, have they really, met the mark in terms of what you'd expect from long-term returns from a retirement product?
Correct. So to compare apples and apples, now if I've spoken so much about SBI, 10% is the CAGR, 3-year CAGR for the retirement fund. And their flagship fund, I would call it the SBI Large and Mid Cap, which gave 22%.
Oof.
Right? ICICI Retirement Fund gave 11.64 for 3-year CAGR, and their flagship fund, which I would call the large cap fund, is 21. So is there a 10% difference? No, HDFC's retirement is 9.96,
Yeah.
and HDFC's flagship is FlexiCap, as we know, 26%.
Wow.
Now, if you look at this kind of difference, then when you're calling it retirement, and
Yeah.
then their own flagship, I'm not comparing HDFC
With
with
anybody
SBI.
else, yeah,
There is a
yeah,
10-15% CAGR difference.
Yeah.
And now you extrapolate this for 20 years.
Yeah.
The guy will have to cut down his lifestyle by 1/10 to 1/10.
But now we understand, because if the equity portion is capped at 38-40%, then long-term returns, how will you get the benefit of compounding? And hopefully SEBI is addressing that by now offering more flexibility in retirement products where you can have a much higher equity component as well. Okay, on that note, we do have to take a very quick break, but on the other side, we get Feroz to talk mutual funds, specific funds for you to watch out for. This time around, we'll discuss some underperformers and whether there is a turn in performance around the corner.
Let's talk money